Morgan's Jamie Dimon calls them anti-American, and Deutsche Bank's CEO doesn't like those higher capital ratios either. The Institute of International Finance has released a new report saying tougher rules for banks worldwide could cost more than 7 million jobs in North America, Europe, and Japan. Philip Suttle is the chief economist for the IIF. He is with us live from Brussels this morning. Philip, before we get into the report, and it is important and we are going to go into detail there, I want to ask you about Jamie Dimon's remarks in the FT yesterday. He says America should consider pulling out of the Basel group that produced the Basel III rules for banks, an agreement among financial institutions, or at least their regulators worldwide. What would that do to the global financial industry?
Well, it's hard to pronounce on something that's a little hypothetical, but it clearly wouldn't be, I frankly think, wouldn't be a good event, because I think it's important we have coherent, internationally agreed rules, partly for the safety of the system and partly to make sure that we're dealing with a kind of competitive industry, one that doesn't involve distortion. But I think there's always long been a bit of a tension between the US and the European authorities over implementation of Basel, and as the world gets a little more fraught, you're going to get these national differences. But we think it's very important that you have international agreement.
Well, what if the bank chiefs begin to have some success with the argument that they're making that these bank regulations, higher capital requirements, etc., should be softened? What's to stop a race to the bottom?
Well, I think what you've got to put into some context is what needs reforming and changing and what may be a little bit of overkill. And we feel very strongly, and I think Jamie Dimon himself has expressed this very articulately, that there was a deep need for significant reform after the crisis. The crisis revealed a lot of problems, and frankly, a lot of them have been fixed, and many of them that needed to be fixed will also be addressed by the implementation of Basel III, which is a good thing. What we're worried about is the kind of overkill which comes from over-regulation. And so on top of Basel III, for example, we're seeing this thing that's called a SIFI surcharge. And that's, frankly, in our opinion, something of an overkill, which adds to stresses for a banking sector that, as you've been focusing on all morning, is already under strain globally.
But would the SIFI surcharge, for example, be appropriate at a time when the global economy is stronger? It's just a matter of waiting until it's not so weak any longer?
Well, that's a good point, and I think there are some very good arguments for making sure that some of the distortions that maybe promote larger institutions to do well and maybe perhaps even do too well in the good times, that some of those issues are addressed. But I think what we're looking at is the real world. We're looking at the real world today, and that sort of introduction in the near term and the threat of the introduction, it's not so much the promise that it's going to happen in the future, but the threat of it, which forces markets to adjust to that today. The thing to remember is financial markets look ahead, and if you say you're going to do something in the future, they're going to want to see it priced in today.
But Philip, to throw that back at you for a moment, in the real world, banks are loosening credit standards. That's what the Fed told us in its July senior loan officer survey.
Well, you actually, it may sound a funny thing to say, you actually want that to happen. I mean, what happened after the crisis is banks went from too loose in the immediate build-up to the crisis to way too tight in the aftermath. And what you actually really need is for banks to begin to lend again. I think everyone actually seems to agree on that point. You need to free up the credit process. And what worries us about a lot of these reform measures, and the reason we have these estimates that you mentioned earlier, is that we see many of these measures, well-intentioned as they may be in the longer run, as actually having very severe transition costs and hindering the expansion over the next 2 to 3 years.
Philip, it's a conversation to be continued. We look forward to having you back on the Inside Track. Philip Suttle, he's the chief economist at the Institute of International Finance. And